Good afternoon, ladies and gentlemen. Thank you for taking the time to join us during some of these unprecedented times. First of all, I would like to wish all of you who've joined this webinar today health and safety, and those of you who are in the midst of these unprecedented times in the region, I hope you're all well and safe. As developments continue to unfold across parts of our region, our focus remains on the safety and well-being of our colleagues and clients, as well as the ongoing stability of our operations as we continue to serve you as your preferred bank to support you without any disruption. We at the bank at Standard Chartered are here to be a trusted partner with you and help you manage your wealth in a way that is aligned with your objectives, time horizon, and risk appetite. And during events such as this, one can always feel that they need to go back, relook at the position, and listen to the expert to understand how best can you be able to then navigate and align your portfolios to your wealth preservation and growth. With that in mind, we're keen to gather you virtually today to keep you apprised of the impact that these recent developments have had on markets and certainly reinforce our commitment to you. You will be meeting colleagues who you have met before several times. We have Manpreet with us, who's our Chief Investment Officer for Africa, Middle East, and Europe. And we have Pratibha with us, who is our Head of Advisory and Managed Investments for Europe, Middle East, and Africa, to give you some insights so that you can be able to hear them, reflect on that, and of course, ask questions. Ladies and gentlemen, I'd also like to remind you that your relationship managers, your investment advisors, and the entire team here at Standard Chartered are here to serve you, to listen to you. So please feel free to reach out. When we say we are here for good, we are here for good. And during times like these, we believe that it is extremely important that we come and speak to you at the first instance. So this is not just the only webinar that we're going to do. We're going to host many other such webinars so that we can remain close to you, listen to your queries, and give you timely, informative information that is coming through our group head offices, as well as our Chief Investment Office, and the various insights that then Pratibha and Manpreet can bring your way. So please feel free to reach out to us, as well as your relationship managers and investment advisors, whether remotely or for those of you who have accessibility face-to-face as well. With that, I'm now going to hand it off to Pratibha, who's going to take us forward and tell us a little bit about how best should we be now paving the way forward and navigate the circumstances that we're in. Thank you very much. Pratibha, over to you.
Thank you very much, Aisha, and good afternoon, everyone. Welcome to our session today. This is being held and run from Dubai. We all know that the world feels a little bit uncertain right now, and much of that uncertainty is centered around the Middle East and what's happening here. But we thought it's important for us to bring you all together to share our thinking and also have an honest conversation about what it all means to us and our portfolios. As Aisha mentioned, without further ado, I'm just going to jump in and start asking Manpreet a few questions so that he can share with all of us the thinking that should be going into our portfolios as well. Manpreet, thank you very much for your time, as always. To set the stage for the audience, I wanted to just start off by checking in with you. How are we characterizing the current situation in the Middle East? And maybe could you just walk us through the scenarios, a scenario tree, if you'd like, in terms of de-escalation, contained escalation, and a broader regional spillover? How does that all look at the current time? And also, if you could maybe compare to any previous episodes of such regional instability we've seen in the past decade.
Absolutely. Thanks, Pratibha, and good afternoon, everyone. I hope you're all staying safe, but I think for today's conversation, obviously, it's important to take a broader view and obviously look at markets and market impacts from a more dispassionate perspective, which we think is obviously the best way to think about impacts on investment portfolios. Now, I think we all know from a headline perspective what's going on, right? But I think from a market perspective, any geopolitical risk of this sort, right, the first thing we try to think in terms of is what's the specific link back to financial markets, and what impact are we seeing there? I guess you don't need me to tell you that the obvious one is energy prices. Oil is the one that's on top of everyone's sort of mind, but also gas prices, as we learned yesterday. So I think when we sort of think in terms of scenarios in comparison with history, I think from a market perspective, we really think into different scenarios for oil prices and energy prices, how those could pan out and what we can learn from such scenarios in the past. History, obviously, there are mixed sort of bag of comparisons there. There's always, whenever there's a crisis in the Middle East, there's always a comparison to the 1970s, which we're not fans of because the 1970s was a very, very different environment, both in terms of dependency on the Middle East, but also the percentage of consumer spending that went on energy. Today, we're in a completely different world, so that's not a great comparison. But obviously, we experienced a short conflict, in the middle of 2025, not that long ago. And we did see oil prices obviously rise briefly, but it proved to be quite a temporary move that was almost fully reversed. I think where it leaves our thinking, right, is that, in terms of scenarios we see from here, there are really three defined around oil prices. The baseline scenario for us is still one that oil prices rise. We initially said over the weekend to $80, and we're about there on Brent prices. But the key here is how long they stay there. Because in our baseline scenario, this rise, if it proves to be temporary because, the physical conflict, or at least the part of the conflict that concerns, the production and the shipping out of, oil, if that proves to be relatively short-lived, so in other words, weeks rather than months, then the broader market impact would be relatively contained, because, you don't see the knock-on impact on inflation or emerging market currencies and so on and so forth. And that's why at the moment, what we're sort of seeing as a baseline scenario for now. Obviously, there are tail scenarios around that. There's an upside scenario where we end up back at the negotiating table quicker than we all expect. But there is a downside scenario where, because of events, oil and gas prices stay at these high levels or much higher for a more prolonged period of time. So in other words, months rather than weeks. I think that's the scenario where we'd see a more real impact on inflation and then all the things that follow from that. So I think that scenario framework, in our case, mind is sort of a good sort of mental framework in which to navigate the news that's hitting us, minute by minute, hour by hour. But for now, baseline scenario, we're looking at, a rise that persists perhaps for a matter of weeks, but proves not to be long lasting.
Thank you, Manpreet. I think that sets the tone for us in terms of what to expect. But, geopolitics, whenever it escalates, markets often react in phases. How should clients think about the first 48 hours versus the next few weeks? I know you covered it in some parts, but in terms of, positioning, how do you think they should, think about their portfolios?
Well, I think it's a great question, right? And I think the key learning from past geopolitical events is to separate the short-term knee-jerk reaction to the longer-term fundamental impact, right? And we have decades of financial market history on which to test this with. And I think a key learning consistently across the decades in the post-World War II world is that in the short term, in the days that follow a geopolitical event, it's natural for there to be concern and sentiment-driven pressures on markets. And if anything, the outcome has been perhaps not quite as bad as many reports or forecast over the weekend at least came across my desk. So I think that initial knee-jerk reaction is natural because it's hard to predict, where we go. But I think in the short term, overreacting from a portfolio perspective can be problematic. And I think that's why in the short term, we put out a note on Friday, for example, before we kicked off, was that we prefer putting hedges in place, energy sector equities or inflation protected bonds, rather than touching the core portfolio allocations from a well-diversified multi-asset portfolio, because that allows you to navigate sort of the near-term knee-jerk reaction and then assess, whether fundamentals are changing or not. Of course, long-term, in the vast majority of geopolitical events, the change in fundamentals, if it's not long-lasting, then short-term hedges can be enough. But of course, there are the occasional ones where there are changes to fundamentals, as we saw for Europe, for example, in 2022, when the Ukraine conflict started and natural gas prices jumped. So I think those helps you sort of buy time to separate mentally short-term knee-jerk sentiment reactions from fundamental shifts. And thinking more in terms of short-term hedges helps in maintaining diversification, that by all of these buy you time. while we're all able to reassess which way the fundamental picture is going.
Great. Maybe just let me just pause here for a second and encourage our audience to post some questions, whatever you want answered. I think this is a great time to do that. There is a Q&A option available on your Zoom app, and so you could just post in, and then we'll try and address some of those towards the end if it's not already covered. Okay, coming back to this, Manpreet, so getting down to a little bit of details to what we're seeing in the region, right? The Strait of Hormuz, that carries roughly about 20% of the world's seaborne oil. How are you thinking about the tail risks of any disruptions there, right? And what's your base case for oil prices for the rest of 2026?
So I think for the disruption, obviously, that is the most well-flagged risk of any geopolitical event in the Middle East, right? And to some extent, we're seeing elements of that start to play out. But I think, like you said, it carries 20% of the world's sort of crude. That's actually a lot lower compared to 1970s, for example, and hence our point. But the other point, of course, is that let's not forget that a lot of these disruptions are coming against the context of an extremely oversupplied oil market. So if you go rewind your mind back to last week and before that, our view of oil prices 12 months out was range around $60 per barrel because there's considerable excess supply globally compared to the levels of demand. Now, I think the Strait of Hormuz narrowly, obviously, look, the length of any disruption will be the key here because short-lived disruptions markets can deal with. If they prove to be long-lasting, that last months, that can be more problematic. Because of how much supply they take off the table. The longer the disruptions, the more permanent that can become. And also because producers that are dependent on the straits to ship sort of output outside, they also have limited storage capacity before they really need to ship it out. The other factor, of course, to balance that is that when we talk about a lot of spare capacity, particularly on the output side, much of that also sits in the broader sort of Middle Eastern region. In producers like Saudi and the UAE in particular. So, of course, there you start to have conversation on, again, how much of that are they able to sort of ship out of the region and whether it's disrupted by the geopolitical event. So, look, to my mind, that sort of leads to why, in my mind, it's explained why we've seen the reaction over the last 2 days being maybe a little more benign than we expected. But I think it so far is playing out alongside our baseline scenario that prices rise to $80. On the short-term sentiment reaction. But the key, crux factor here is how long these disruptions last. Because, like I said, if we're talking weeks, then markets will likely get through it. And I think markets are pricing to some degree of probability that's the scenario we see. If we are talking months-long disruptions, then of course that starts to chip away at the excess supply picture globally, and you might see prices sort of hold for higher. I think that timeliness is really the key thing to monitor here, more than just a disruption itself.
Yeah, I know. I understand there's a lot of moving parts to the situation right now, given that it's possibly fairly early and, to our base scenario, if this continues for a few weeks and, kind of subsides beyond that, then things should be under control. However, I mean, historically, we've seen that if oil goes above $100 per barrel, that could push inflation up by about 0.6, 0.7 percentage points. How does that feed into our overall inflation outlook? And what does that mean for central bank policy paths, especially for US and Europe?
I think that's a great point, because I think then what the situation or scenario you're describing is sort of more fits with what we'd call our downside scenario, right? Because I think if you have a situation oil prices rise, let's say well above $80 for a sustained period of time, I mean, 100's a nice round number that the media really likes. That's a scenario where you would start to see markets start to worry about its inflationary impact. And I'd expect to see that first in US inflation markets, sort of inflation expectations, yield on inflation protected bonds, and then obviously increasingly in the policy context to say, look, is inflation returning as a potential challenge? Now, in that scenario, of course, the main channel of concern will be central bank policy. One central banker from Europe, for example, today start to comment on that to say, look, if inflation starts to become more of a challenge, then it makes it much harder for central banks to continue cutting interest rates. Our base case scenario assumes that the Fed in particular continues to cut rates another 2 to 3 times this year. And that's, of course, good for risky assets. But if you start to take that assumption away and the Fed is sort of forced to either hold rates or potentially even raise in response to higher inflation or inflation expectations, that obviously goes down a very, very different scenario. And look, to some degree, it comes back to an earlier point that I think the length of any disruption is quite key. You don't see inflation expectations jump overnight. Jumps and see it on a slower or more gradual sort of pace. But that is also why inflation protected bonds are one of our first ports of call when it comes to trying to think about short-term hedges. And that helps buy some time. For if we end up in a situation where to reconsider any sort of long-term allocations. But I think the impact really we need to monitor is it's more than oil prices, the US inflation expectations number, and how central bankers react to it. And I think, and to what degree it might constrain them or not in terms of supporting growth.
Great. Now, again, I'm going to probe a little bit into the inflation piece, right? Because it's been top of mind for a lot of investors, also because of all the noise around tariffs, right? So I just wanted to understand, I mean, geopolitical strategists are saying that 2026 is far from a Goldilocks kind of a situation, and investors should position for structurally higher inflation with lower growth as well, right? So do we, in our context, agree with that framing, and how is that shaping our baseline asset allocation, so to speak?
So I think in our view, if you look at our sort of annual outlook, I don't think we've generally been in the camp of Goldilocks. I think we viewed the environment as more one of soft landing, right? And so we're happy to be surprised positively, of course, but we think the growth picture, of course, there are some challenges. And I think if you look at the US job market, you can see that growth, of course, has its challenges. A little bit on the softer side in some areas, and inflation. Look, the levels of inflation are still on the higher side. I think the reason we believe the Fed still has room to cut rates towards what we viewed as more of a neutral policy environment is because at least it was going in the correct direction. And I think, look, that is where our views, were really sort of centered on. But if you think about it, a reasonable amount of growth is still good for earnings, right? As long as we're getting positive avoidance of the big downside scenario, equity market earnings can keep growing. And I think that's why we think an overweight in equity still makes sense, leaving aside the big extreme downside scenarios, of course. And if you think about inflation protection, actually, in inflation ranges, below what I'd characterize as very high inflation, go above 3.5% to 4%, that's a different world. But below those sort of extremes, actually equities do a great job in providing, some amount of hedge against long-term, sustained high inflation. So that, as long as we avoid the downside scenario, equities can actually do a pretty good job in that environment. It is why bonds are perhaps not our first port of call in a multi-asset portfolio. Obviously, we think the more riskier bonds, like emerging market bonds, can help. It's still a great place to earn a yield, but we're not expecting the highest total returns compared to, let's say, equity markets, where obviously get that sort of inflation protection. And that is one of the factors that feeds into our overweight on gold. Now, gold we like for a variety of reasons. The number one of the list being the fact that emerging market central banks are buying it, but commodities more broadly, think about them as being, again, another way of adding some protection against inflation. So I'd argue our long-term allocations are positioned for positive growth, not Goldilocks, and some amount of inflation. And I think that is when a base scenario, we're quite happy to stay with that and just cover, the near-term challenges with hedges. I think to really consider changing that sort of portfolio position, we need to see something more significant happen, or for oil prices to rise by considerably more and for much longer.
Great. I think it's a great segue into our next set of questions, right? What I wanted to do was see if I could cover off some asset classes. So I think equities, you've touched upon it. They have absolutely shown resilience over the last few geopolitical episodes, if I can call that. Is this time any different? And also, does any of this currently change our view on US versus Europe versus EM in terms of a view?
I think at a broad level, I would say no. I think, for equities, they have been, like you said, by and large, with maybe a few exceptions in some emerging markets, equities have actually been remarkably resilient. But I think that feeds back to where we started in terms of oil prices, right? That, so far it's been a relatively maybe more contained rise compared with expectations or fears. And I think most people most market participants, at least we've sort of read and spoken to, seem to be looking for disruptions that are in the span of weeks rather than months. But I think you raise a good point in terms of the US versus non-US and emerging markets, right? Because our overweights, we've always, since start year balanced, an overweight in the US with an overweight in Asia. Now, our core long-term view is that we get dollar weakness, and that, of course, should lead to continued outperformance of non-US markets and Asia, China and India particularly. You would have heard me say are our preferred markets. But in the short term, we can see the dollar is playing a little bit of a safe haven role. And I think that's where, in the short term, we could see that relative outperformance coming more so from US equities compared to non-US equities, at least for that short temporary period of time when the dollar sort of plays a safe haven role. And then, because you can see where the challenges come from. For most of Asia, for example, they are oil importers. Higher oil prices are a challenge from a growth and currency perspective. And obviously, the jump we saw in European gas prices, almost 50% at one point before they pulled back, that, of course, can be a challenge for Europe. So, again, as long as these are not very long lasting, we think this trade has room to unwind. But for now, we think that overweight in US obviously is helping us on the equity side as well.
Okay. Just touching upon credit markets, right? What's your view on credit market implications, especially for MENA credit and spread behavior during a risk-off situation?
So I think the knee-jerk reaction, I suppose, is corporate bonds, credit, EM bonds, they all trade at risky assets, right? So if we see this, translate into a slightly bigger sort of pullback in risky assets like equities, one should expect credit spreads to behave the same way, right? They generally do when they're correlated, particularly at the riskier end. So that would not be unusual. But I think one should expect to see, obviously, in this region, it's natural to question whether there would be a bigger impact on regional credits. But again, the perspective I'd add on credit markets, and particularly in the GCC region, is that the starting point is extremely tight credit spreads, right? The biggest challenge we've had as buyers is that just how expensive valuations are. So when you start to add in even a little bit of risk premium, it's natural to get spreads that are a little bit wider. But when you think about the GCC in particular, different implications for different regions, but GCC in particular, let's not forget that most sovereign and sovereign-linked issuers fundamentals are extremely strong. So relatively little concern from a credit quality perspective. And if you think about it, actually, it's a lot of higher oil prices, as long as volumes sustain, are actually credit positive rather than a negative for the credit. And I think that's why, despite everything we've seen, and I'm sure many of you are experiencing firsthand, we haven't actually seen that big a move in regional credit, again, outside of the riskiest exceptions. I suppose one would expect a little bit more for reaction in the broader emerging market universe, simply because of, similar to equities, if emerging markets are energy importers, higher oil prices can provide a bit of a headwind. But still, that's an area we've been overweight. If we get a bit of spread widening, I think the bigger picture approach we take in our base scenario is that we may end up more of an opportunity rather than a concern, as long as these energy price and disruptions prove to be temporary.
Okay, so we covered off a little bit on oil earlier, but if you want to look beyond oil, where do you see meaningful moves? I know gold has appreciated over the last few days, apart from what it's been doing over the last few months, but also from a currency perspective, right? We've seen USD, CHF, JPY, typical safe havens. How do you size those exposures without overhedging?
So I think it's, I think you put it very well, right? It's almost like a tiering of what sort of hedges you might put in place. I think the first port of call was, like I described, energy sector equities, inflation protected bonds, because that's where concerns might be centered first. I think gold and safe haven currencies like the Swiss franc, they tend to be more traditional safe havens during risk-off periods. But I guess we're coming off again a period where both have actually strengthened a fair amount, year to date, and gold, of course, for much longer than that. So, in our mind, gold is sort of one area needs to look. There are a lot of positive tailwinds for gold, and this just adds one more. But we just think that more importantly comes against a backdrop of emerging market central banks, if anything, will continue buying, in our view. So there's a great uptrend in gold. We think the fundamentals are supportive. So that's, of course, a good place to be. Obviously, if we have sort of, even in the short term, an intensification of some of the worries we've been discussing so far, you could see a spillover into more safe havens like Swiss franc. But like I said, I think the matter of degree matters here simply because of how much they've already gained so far year to date. But sorry, on your point on sizing, I think that's where it comes to, I guess, the importance of diversification. And I think many of you might be bored of hearing it from me, but if I just look at our own portfolio performance, and some of our stress tests over the last day or two, this has been yet another example of why it's so important to go into these events well diversified, because, of course, it's natural for some asset classes to be impacted, asset classes, currencies, safe havens. But I think having a broad spread to begin with is what really buys you time to reallocate portfolios. So including on these safe havens doesn't mean we hold excessive amounts of these, right? So gold, for example, is a 5 to 7% allocation across many of our balanced allocations. Currencies, we've always, advocated diversification. But I think that's sort of one of the biggest takeaways.
Thank you, Manpreet. No, that really gives a lot of perspective in terms of, positioning as well, right? Because currencies, especially, you don't really have just spot positions, but you're literally across, cross-currency lending and things like that. But we'll touch upon that because I do understand there will be questions related to that. But coming back to, equities again, if I could just wind back there, right? And bringing all of the pieces around tariffs as well. I know while we are specifically talking about geopolitics at the moment, but, the bigger picture still remains that the tariff piece is, still very uncertain. We're seeing a lot of companies rapidly reorganize supply chains along the regional blocks, right? How should one think about the longer term structural shifts in global trade? And what sectors or geographies stand to kind of gain from all of this?
So I think when you think about some of the changes you've described, right, it's something we've seen already happening almost at a continuous level over the past couple of years, right? But I think when you think about supply chains, about changes in investment flows, in our mind they feed into for investors in two specific ways, right? Number one is what our conversation around inflation, right? Over the last 2 to 3 decades, the focus has been on efficiency, which of course has been deflationary, but on its own, building that sort of supply chain resilience and sort of building of more narrow blocks as opposed to free global trade, that is inflationary on the margin, right? So it can be a challenge for economies facing higher inflation, perhaps a positive for some economies which are still facing deflationary pressures. The second is, I think it just comes back to reminding us that as equity market investors, why it's important to also think globally, because it's natural, right? If you go back over the past couple of decades, US equities drove pretty much the bulk of returns. And there have been obviously several other winning markets along the way, but it's still been a very US equity market centric world. And to be fair, we still think US equities will do well, right? And if you just think about some of the big emerging themes, and we haven't, it's one of those rare calls where we're not discussing AI in a big way. But in terms of listed market universe, the US markets still provide the most exposure to strong earnings growth trends of that sort. But I think what that world you're describing means is that we're getting many, many more opportunities outside the US. And that's coinciding at a time which, leaving aside the topic of discussion today, the short-term risks, we think will translate into a gradually weaker dollar. That's great from a historical perspective for non-US equity markets, but it equally means you're getting more and more opportunities and are likely to continue doing so outside the US from an equity market perspective. So having a good balance between US and non-US equity markets, and obviously our current preference being more Asia, but still holding small allocations to the rest, that we think is the best way to take advantage of it, particularly protection against these sort of unexpected events.
Right. Okay. Great conversation going on so far between Pratibha and Manpreet. And Pratibha, I'd encourage you, please, to keep bringing in questions, because I know you're getting the questions over emails and otherwise through the RMs and advisors who the clients are reaching out to as well. But Manpreet and Pratibha, there's some questions coming on over here as well. And I do understand that some of these you're already addressing by this conversation, but I'll just pick a couple up, which are quite close to some of our clients, specifically with regards to portfolio positions and where there is a leverage position in a cross currency. So the question is around, a client of ours asking that they have 50% lending in CHF and CNH against a dollar invested in income funds. And what do you believe they should be doing in terms of their lending position over the next 1 year? Should they end the loans how should the stance be? Now, I know that we do not have details of the portfolio, but on an overall basis, is there anything that you can be able to advise now? Pratibha, maybe you can start, and then Manpreet, you can come in. Thank you.
Oh, thank you very much, Aisha. And it's a great question, right? And that's precisely what I was referring to, that, the currencies piece doesn't really just end in with spot currencies, but also there are a lot of our clients who indulge in cross currency lending within their portfolio to maximize returns. Now, one of the things that we've, been, I think, advocating for a fairly long time is that diversifying your currency exposure is very critical. That is one area of the capital markets that can be extremely unpredictable, but more so moves extremely fast as well, right? So I think what you've done with the portfolio, that you've had a position across CHF and CNH, that itself is a good way of diversifying. But I think one thing to look at it is to reduce your exposure, depending, again, as Aisha mentioned, we don't have your specific portfolio here, but definitely look to reducing that risk in the portfolio. And then also see if there are other currencies that can be added if it permits. What I would definitely advocate is please reach out to your advisor and relationship manager, who can then specifically look at your portfolio and advise in terms of what is the next necessary step. But I'll pause, and maybe Manpreet can have a go at it.
No, I think maybe I'll add three big picture sort of points, right? And we obviously can't discuss individual situations here, but please do reach out to your advisor there. But I think number one is, yes, but I already mentioned the point on diversification, right? So, two currencies is actually a great start. I think I like the fact that it's low interest currency plus less volatile Asian currency. But currencies, in my view, when you're thinking about the movement in spot, is always a risk management exercise. So the more diversification, the better, right? And I think that would be the number one thing. Second would be to say, look, I would actually consider going, US dollar as well in that mix, right? Let's not forget, why we're looking to non-dollar currencies to begin with is because a few years ago went to a period where US interest rates went up, and there's a relatively narrow gap between dollar borrowing costs and what you can earn on the other side, and that obviously sparked a search for alternatives. But in a world, again, assuming we go back to a world where the Fed is able to continue lowering rates, then actually, your need to add more and more currency risk in order to lower your borrowing costs, that need will hopefully continue to reduce on the margin. And third is, look, at the end of the day, the third lever, which we also don't discuss enough, is how much do you want currency risk do you want to take on? How much leverage risk do you want to take on? Because remember, it's not a binary call. It's not an all or nothing conversation. Currencies, as Pratibha mentioned, are ultimately very volatile assets underneath. And one way, to sort of deal with that, even if you, limit yourself to a handful of currencies, is also to say, look, between the dollar and non-dollar at a total leverage level, how much leverage risk do you really want to add here? Because, all of these are different sort of levers you're able to play with. And just like any other portfolio decision, I think it's trying to get that sweet spot between getting enough to generate the returns and yield you might be targeting, but also, not overdoing it so you're able to handle volatility and survive, the two-way movements in markets, which is a natural part of being invested.
All right, thank you. Thanks for that useful information. Now, this also comes back to the situation on rates, with the current situation, the wider macroeconomics, the energy prices, what the commodities are looking like. What is the outlook on rate cuts staying? Is it changing? What are you looking at in the medium to long term? Manpreet, first to you, and Pratibha, if there's anything to add then.
So I think on rate cuts, the most important one here is the Fed, right? Because I think outside of the Fed, Europe has already gone through a cycle of rate cuts. We're not expecting more. And Japan, other markets, of course, if anything, also flat. Japan potentially may actually be raising interest rates. So it really comes down to whether we think the Fed can continue to cut US dollar rates. And in our view, look, at the moment, our answer is that we still think there are 2 to 3 more rate cuts, in the pipeline. And that's coming more from where we see the current growth and inflation picture, independent of what we're discussing about oil prices at the moment. Because if you think about headline inflation in the US, it's been consistently moving in the right direction. And more recently, we've seen policymakers focus more on what is still a relatively soft job market, right? And 2 to 3 more rate cuts, doesn't suddenly make Fed policy super easy. It just takes us back towards what the Fed itself has told us in the past is a relatively neutral stance, as opposed to a slightly restrictive one at the moment. But I think the key to whether we need to adjust that view comes down to where we started the conversation around how long oil prices and energy prices stay high. Because again, this entire disruption and the jump resulting rise in energy prices remains temporary, a matter of weeks rather than months, then I think it's quite plausible to go back, to that sort of base scenario. But of course, if there's a scenario where these disruptions, are more prolonged in a matter of months rather than weeks, and oil prices stay well above $80 or towards $100 or more for a more sustained period of time, that's where inflation may rise to the point where it makes it much harder for the Fed to keep cutting rates as we expect at the moment.
Okay.
Yeah.
Would you have anything to add there, please?
No, sorry, Asha. I was just going to point to a question that was posed in relation to the same question, right? In terms of if the current situation persisted, which of course is not our base case scenario, but if it were to do so and energy price shocks could fuel inflation, do we still back the 0.75 basis rate cut is one of the questions. And I think you've answered that, Manpreet. But is there a way for us to kind of estimate that if inflation does spike to a certain level, what it could do to rate cuts, as well as given Trump's position on cuts, so to speak, right? I know it's a difficult question, but just to hear your thoughts on this.
Look, I will start by saying that if you talk to an economist, they'll remind you that inflation is one of the more notoriously difficult variables to forecast, right? So to your point, it's easy to have a one-off saying, okay, if I change just the oil price to 100, you get 0.6 impact, 0.7% impact on inflation. Standalone, that's true. But there are obviously many, many factors that go into inflation. And if you were to sort of take Trump's comments at face value, what he's really trying to tell us is that he's okay accepting a slightly hotter economy in terms of slightly higher than trend inflation rate, but obviously supporting growth, supporting the job market is his priority, as will be the priority of any elected government. I think the challenge for the Fed will be they'll have to deal with it live, is how they balance that, which is part of their mandate, against the risk that they trigger a rebound in inflation, because as we learned not that many years ago, that if you allow inflation to run too high too quickly, pulling it back can actually be even more painful from a growth perspective, right? Many of you might remember 2022. So I think it's not an easy position for the Fed. And look, I think what we can do today is map out, like I said, scenarios of, okay, oil price goes here, and hence that's impact on inflation. And if you step back and think about, for a moment, the numbers you put out, a 0.7% rise in inflation, yeah, it's sizable, but it's not the end of the world. But I think it's often the second order effects that, okay, if transport costs start rising as a result, or wages start rising as a result, I think that's where it can become more of a challenge. So at the moment, I think rather than trying to get excessively precise about the forecast, I think a much simpler rule for us would be to say, okay, we've got a rise in oil prices, but how do we start? Two things we can look at. One is how long are they really staying there? I think if they're sustained, that's quite important. And second is keep a close eye on US inflation expectations, right? It's a market variable. It's, you can all see the price and what markets are expecting. And I think that will give us the key to how much markets are actually worrying about it, because it is possible for oil prices to stay at 80 and perhaps our inflation expectation only goes up by 0.2, 0.3%. Then maybe you get a few more cautionary comments verbally, but maybe not a change in the direction of the Fed. So inflation expectations, I think, is what I'd follow.
Right. Thanks, Manpreet, for that. Now, Pratibha, I've got just one last question here, and then I know that you are inundated with some more questions that are coming through, both for yourself and Manpreet. If there is liquidity available, because there are, clients out there, this that time of the year when year-end bonuses are paid to some, and if there is a liquidity position that clients are holding, what sort of asset classes should they be going for? Manpreet, you covered that a little bit before. Should they be topping up, diversifying more? And then what currencies plays should be considered as well if they are going to consider a leverage?
So maybe the starting point for me should always be, the model diversified portfolio. you might have heard me say this at events, but we publish, what we think an ideal portfolio should look like. It's in our monthly publish every single month. So to me, that should always be the starting point before you start to make any adjustments. Obviously, they're the asset classes we like. So we prefer equities and gold. There are key overweights. So in equities, particularly if we start to see pullbacks in some of our preferred markets, we think that would be opportunities in our base case scenario. So in the US, we have seen pullbacks in parts of the tech sector, for example. We don't want overexposure there, but if I'm looking for an opportunity, that's a good example. We have been trying to build more and more diversification into portfolios. So non-tech sector equities in the US, non-US equities, like Indian and Chinese equities. So if we see pullbacks in either, that will be an opportunity. And gold, of course. Obviously, we don't have a pullback at the moment, at least, but if we did see an opportunity. Then there are the more micro level opportunities. So we discussed, specifically out of what we'll experience in a moment, if we do see some windows of opportunities in regional credits, right? Which, as we discussed, we think credits are strong, but we start to get a bit more value. That's something we would consider. The only point there, of course, is given that whole inflation discussion in bonds, we think a bit of those relative value opportunities attractive, but that doesn't mean we want to take huge amount of maturity risk, right? It does, 5 to 7 years is our preferred maturity, not 20 to 30, for example. So I think that is sort of the window of the range of opportunities we look at. Leverage, obviously, we discussed. While we don't sort of provide a house view at the CIO level, on leverage particularly, I think the key point here is if you're adding currency risk, make sure it's very, very well diversified and make sure US dollar is part of the mix of currencies you're considering. And just make sure you stress test portfolios to be able to survive what is a reasonable amount of volatility. Let's not forget the last 2 to 3 years have been unusually stable, right? Equity markets have gone up in a straight line, gold's gone up in a straight line. Usually markets tend to be a bit more volatile than that. Certain amount of stress testing will automatically give you the answer in your situation, how much leverage might or might not make sense.
If I could just jump in at that junction, right? I think it's key to definitely revisit your investment plan that was set out at the beginning of your journey. I revisit it in terms of a today, tomorrow, forever perspective. Don't let the emotions, which can be pretty, strong at this point in time, given what's happening around us, let you kind of decide what portfolio actions you take, as long as you stick to your investment plan between the today, tomorrow, forever, and ensure the portfolio stays invested for those specific timelines. We've always seen in the past that, some of these short-term blips are all, usually ridden out. So just maybe go back to the basics and, look at investment principles. Time in the market is key, and diversifying portfolios are key. And that's key from what Manpreet's also saying across asset classes, right? Not just overall portfolio, but even including currencies, etc. Diversification is a key point to kind of keep in mind while structuring portfolios. Maybe just jumping on to a couple of questions around currencies, and Manpreet, what I'm seeing over here is an increasing conversation or ask around what is happening actually with the dollar. Why is it actually still acting as a safe haven when it's been depreciating over the last few quarters? Is this a time that we're entering a renewed dollar strength regime, or do you see this as a corrective move within a broader risk-on cycle? And maybe if you could throw in your forecast for CHF as well, that'd be helpful. Thank you.
So I think on the dollar, it's good to have, put sort of what's happening today in a bit of historical perspective. Right? So our expectation has been for the dollar to get weaker. We got quite a bit of dollar weakness last year, and we think there's more to come this year beyond what we've already experienced year to date. But that view is primarily driven by our discussion around interest rates, right? Because we're in a world where most of other major central banks have either already cut rates, now stable, or in the case of Japan, are actually raising interest rates. And the Fed cuts are obviously, meaning that the Fed is now catching up, and that's eroding the interest rate advantage. And it's coming from a starting point of, dollar that in the past 3 to 4 years has been at the considerably stronger end of its usual, long-term range over the past sort of 6 to 7 decades, the post-World War II period. So I think that is really what's driving our view. It's not so much the big picture de-dollarization debate, right? That's more multi-decade in nature. Now, I think there are two reasons why we might be seeing the dollar react the way we are. That dollar strength, dollar return to safe haven in the last day or two. I think number one is considering scenarios, right? Because if interest rates are what's sort of driving dollar weakness, then the discussion we've had to a large part of the call is what if the Fed does not cut interest rates? Or what if inflation becomes more of a challenge? And I guess that sort of leans against the dollar weakness argument a little bit. So it's natural dollar to adjust. The other one is that the reason the dollar can act as a safe haven in many scenarios is in times of market volatility, where that argument comes from is dollar-based investors, which still form the overwhelming majority of global capital flows, tend to retreat to the dollar because they don't want to take currency risk, and they retreat to the safety of US assets, particularly treasuries, which are dollar denominated as well. And that's, I guess, the thread of argument in environments where the dollar acts as a safe haven. That can hold in non-inflation environments as well, right? It does not be that people are buying the US dollar, the US treasuries, or US assets because US interest rates or bond yields are going up. They just mean that actually in a contained inflation environment, bonds are doing their job as a safe haven. So you can interpret it either way, but that's where it's not surprising. It means that the dollar is acting as a safe haven. Now, on the Swiss franc, I'm glad you brought that up because the Swiss franc, as always, is a little bit different. Because when you say stronger dollar, that's true against most non-dollar currencies. But what we have seen at various points through history is that safe haven currencies as a group tend to benefit. So you see the dollar strengthen at the same time as you see Swiss franc strengthen and the Japanese yen strengthen, right? In a very traditional market scenario, those tend to be, most investors go to currencies. Now, the Japanese yen, not so much in the current environment, and that's, of course, just given just how much of a debate they're having over inflation, government spending, and whether how much the Bank of Japan should raise interest rates. But of course, our concern and our 12-month forecast is that there is a risk we get a large sort of period of strength in the yen at some point in the next sort of 12 to 18 months. And on the Swiss franc, though, I think our forecast is 12 months out heading to 75 to 74 cents against the dollar. And look, that's not tremendously far from where we are. And I think some of that is because the Swiss franc has strengthened at a steady pace this year, but actually even over the past sort of 1 year as well. And I think that is why we haven't seen such a big reaction to the Swiss franc as a safe haven, just because of the extent of strength we've experienced so far. But that doesn't mean that even in a dollar-strong environment, you can get a temporary move in a higher dollar Swiss. We still think that the sort of default part will still be on a trend basis towards a stronger CHF and a lower CHF rather than the other way around. I think you'd need something quite fundamental to change about the outlook for the US dollar, for those outlook on the safe haven currencies to change.
Thanks, Manpreet. And I think, I'm just going to stay on this piece just for a couple of seconds more, because there are some questions, and that's relating to the CHF, CNH to USD asset carry trade, which was, actively discussed over the last few quarters, let's say. But the USD, of course, has depreciated over close to 15% in the last couple of years. So, how do you look at this? I also get a lot of questions whether, I have these positions. Should I look at maybe averaging out my positions and, take more borrowing in, Swiss francs? And I genuinely don't think that's a great idea. And also, like I started out earlier, that, there are risks to currencies because currencies can actually move quite significantly and very briskly, on whatever information flows through if when you compare it with other asset classes. So in light of all of this, how would you address somebody's concern when it comes to CHF positioning?
So look, what I would say is maybe three things, right? One is, look, nothing moves in a straight line in financial markets and particularly currencies. So regardless of our view, we should expect that to happen in a series of movements in both directions. So there are many opportunities to adjust portfolios depending on what you're looking to achieve. Second is that I think you brought up a great comparison. I think there's always a temptation to dollar cost average. But I think what's important to remember here is that dollar cost averaging makes a lot of sense for stocks, for equities, because that's the only asset class where there's a default path through the upside, because short of something going wrong, earnings of companies generally tend to grow, and that's why equities tend to trend higher over time. But that's not true of currencies, right? Because currencies reflect economic and inflation fundamentals long run between two countries. And I'll give you a great example, right? Many of you might be obviously familiar with the dollar rupee. The dollar rupee sort of just weakened on a trend basis on an average of 2 to 4% a year over 3 decades. And there's nothing wrong with that. It just simply reflects the long-term trend differences in inflation and real interest rates. So I think currencies are more reflective of how fundamentals are changing on a trend basis between two economies, more than any kind of returning to some sort of long-term average. Right? Conceptually, there's no reason for currencies to do that. It's more dependent on taking a view on what those fundamentals will do in the future. And I think third, that when my last point is, so what can you do about it? Obviously, is that's why we prefer as broad and as diversified a basket as possible. Because at the end of the day, look, when you're sort of taking cross-currency exposure, in addition, what you're doing is in addition to taking on exposure to the underlying investment, the additional return is coming from taking on currency market risk. And there's nothing wrong in that, in taking a view like you do in any asset class. But remember, on the long side, we're all well diversified, right? Whether it's within bonds or across multi-assets. And the same should apply, even to currency views. Because at the end of the day, you have a view on the Swiss franc, but it's single view, right? And I think it makes sense to ensure diversification to the extent possible. And some of the factors we discussed earlier. So those are the three sort of things and levers I use when having a conversation with your advisor.
Thanks, Manpreet. Thanks for shedding a lot of clarity on that space. I think we've discussed a fair bit around inflation, about currency exposures, etc. But I really like one of the questions that have been posed over here. From a fundamentals perspective, what do you expect to have changed in this particular conflict? Even if we did, go with the base case scenario of this, flowing into a few weeks and then, finding a solution, at least in somewhat way. I don't know whether peaceful or not, but if we did go that route, what fundamentally could have changed?
Look, I think when you take a financial market perspective, right, and I'm not looking at regional dynamics because it depends what sort of metric you're following. To me, it simply comes down to how energy markets respond long term, right? Because it comes down to how we think about geopolitics. In every geopolitical situation, you're just trying to say, look, there are many, many ways you can analyze a situation, but markets have a much narrower view of the world, and ultimately it comes down to what's that channel, and how big an impact does it have on the rest of the world, right? And if you can think of the comparison with 1970s, right? 1970s, the oil move at that point had a huge impact on the world economy because there was far more regional concentration and dependency on one region. There was, energy spending was a much, much bigger share of global trade, of individual consumer spending. And you can see since then, just take a look at, for the average US consumer, the percentage of discretionary spend on energy has just moved one way. It's just gone lower and lower and lower over time. So look, to some degree, that's natural. And some of you might remember that, the US went from extremely fuel inefficient cars to actually worrying about fuel efficiency, for example. Today, we're talking electric vehicles. So these are natural responses to crises, which is why we're not seeing the same level of reaction today as we were in the 70s. So one would expect those sort of trends to happen. But I think rather than try to look for sweeping sort of changes in outcome of a single geopolitical event, I think for an investor just sort of thinking about that one channel, which is energy markets, to what degree can that sort of A, go back to normal, and B, respond long term to continue to reduce dependency on single sort of events. I think that is trends one would expect to continue.
Thank you very much, Manpreet. I think this has been extremely useful. I just have maybe one last question for you, and then we can close. But if volatility were to rise, do you see it more as a risk to reduce or an opportunity to rebalance into our more favored asset classes?
I guess it always depends on the context in which volatility is rising. But no, I think initially I would look at it from both ends, right? Because I think there is obviously opportunity to make sure that there's not excess amounts of volatility. So step one, of course, is we discussed a lot of hedges so that at a portfolio level, you're not exposed to undue amounts of volatility. But let's also not forget, right? The best opportunities come amidst the biggest sort of threats and most volatile periods. They don't come in calm markets, right? So I think it's equally important these markets have sort of one antenna saying, okay, how do I make sure I protect my investments and against a range of scenarios? But equally to say, look, we're going to get some great opportunities. You almost always do out of every crisis. Where should I be looking? How should I be thinking about those? What does my portfolio need that I don't have today? So I end up with a better portfolio at the end of this current episode. That's actually equally important, right? So I think it's about both. And that's why if you think about some of the notes we've been putting out in the conversation we're starting to have in our investment committee, it is on both sides. And what we discussed about regional credits is a great example. Everyone wants to own them. They're great credits, but they're getting increasingly expensive. So some challenge for someone looking at valuations. If we get even a little bit of better relative value out of that, that would be a great opportunity to take advantage of for anyone with a long-term approach.
Great. Thank you so very much, Manpreet. This has been extremely useful. Very quickly to summarize, I think, you of course covered off a number of points across various asset classes, but I think to our viewers, one thing that we want to really leave with you is, we're aware, we're there. Please reach out to our relationship managers and investment advisors. There are active strategies that we can take on your portfolios. As we mentioned, there are hedges that can be built into your portfolios. Diversification is one key strategy. And of course, revisiting the initial plan, I think that is very, very critical, and not letting your emotions sway and come in the way of some of your decisions in the short term because of volatility. I think those are some of the key things that we kind of highlighted within this conversation. So I do really want to thank you, Manpreet, for this incredibly valuable and clear-eyed perspective on a genuinely complex situation at the current time, right? So thank you. But at this point, maybe I'll request Aisha if you can just come in and maybe give us your closing message. Thank you.
Thank you so much, Pratibha. Thank you. You've summarized it really well, and thank you, Manpreet, for coming through. To all our clients who are attending today, this is just a reassurance that we're here for you. Our operations remain resilient. Please reach out to us, your relationship managers, advisors, and all of us here at StanChart, wherever you need advice or help in order to help you navigate. And as Pratibha has rightly highlighted, that your core portfolio, your core strategy remains intact. There's some of the tactical plays that may come in the way that can be utilized. There's always an opportunity in these circumstances as well, but remaining close to your relationship managers and your investment advisors, and really listening to them, because their advice and feedback is going to be based on expert analysis and reviews that come through our Chief Investment Office as well. So we remain at your service. Please stay safe and stay well, and we wish you all the very best. And as I said, this is not just one of the only webinars that we're doing. We are going to be coming back, and as the situation unfolds, we're going to either see you virtually or meet you face-to-face as well. But we remain, and all the best to you. Stay safe, stay blessed. Thank you very much. Goodbye.
Thank you.